Okay, did you find me? I'm here. I'm back. This is terrible. I don't know what to tell you. It's a bad connection. I'm gonna have to look into this. See if we can make it for another 45 minutes. Oh. So, where did I leave off? I think you stopped listening to me here. I'll just wait a moment. See who else shows up. Okay, so in conclusion of this part, we've decided to stick with the capital asset pricing model. Cost of equity using the recent historical market risk premium. And we continue to think we should invest in the UAir project. We could even recalculate the NPV, and it even looks better than before because the discount rate is smaller than before. If we didn't have, we don't have to calculate the NPV, we could just use the internal rate of return to tell us that the project is acceptable. Of course, if we use this really high one, we would have rejected the project, right? Because comparing it to the internal rate of return of the cash flows, we would not reach this required rate if we kept it so high. So, all right, so now we've done 3 different calculations. We stuck with this one, and now I'm going to add some more things, and we're going to recalculate the required rate of return again. So we assumed that UAir was all equity, and we assumed that the Bahamas project was just as risky of UAir's other operations. And it might not necessarily be the case. So currently, it appears as though with a beta of 1.55, we computed using the CAPM that the expected return should be 5.27, but with the IRR calculation, we found it's 10.26%. 10.26%. Wait a second. What is that? Yes, okay. 10.26%. That's from here. So plotting this here and remembering what our discussion was of out of equilibrium assets, this is clearly undervalued and you should pursue UAir, Bahamas project. I think that's better to write than, I think that's the problem with what I've written here. This should say Bahamas. The project ends up here. We only needed this, so you should go for it. But what if we introduce debt? So the firm is not only it turns out the firm is not only a stock issue firm, it also issues debt. And just for some discussion about how that changes things, remember our balance sheet, right? Our balance sheet must be balanced. Assets on the left are what is owned by the firm, and on the right are liabilities, what is owed or who is owed by the firm. And those are the stockholders who own the firm and creditors that have um, first dibs on any profits. I mean, they have to be paid before shareholders get their residual payment, either in the form of dividend or as retained earnings. They're reinvested. Any profits are reinvested into the firm. So the firm's assets are financed by both debt and equity in a what do I call this? In a firm that's not an all equity firm. And I'm just going to relay some notation for you where V is the market value of assets of the firm. So we're going to use V for S plus B, where S represents the value of stock outstanding and B represents the value of debt outstanding. Just going to monitor the stream health for this video. Okay. So what do we have here? We have the notation S as the market value of outstanding stock. And the returns to stockholders will be denoted by RS, return on equity. And the risk, the systematic risk of equity, will be denoted beta S. We also have debt, which is going to have a market value of B. So B is the market value of outstanding debt. And RB will represent the return to bondholders, also known as the cost of debt. So this is your yield to maturity of your bonds, for instance. And the beta of debt will be denoted by a beta B. So don't get confused. They're both B's, but one's Greek and one's not. And finally, when we refer to all the assets of the firm, we talk about V. V is the market value of assets of the firm. And we can also speak about the return to the assets, right? So this is, we're going to talk about the average investor in the firm. So there is a theoretical, or I guess it's theoretical, average investor who is partially invested in stock and partially invested in debt in the firm in the same proportion that the stock and debt are outstanding relative to the value. So we're going to talk about this character as well. So there's stockholders, there's bondholders, and there's the average investor who is both stockholder and bondholder in equal proportion to the proportion of debt to equity. Now, obviously, in reality, there's other types of investors that are, not exactly like the average investor, but we need this to talk about the firm perspective. All right, so then we also have the beta of assets, which is the risk of, we refer to a firm with debt as a levered firm. Okay, so it has leverage, or it's levered or levered. So about the weights, where S is the market value of outstanding stock, And B is the market value of outstanding debt. We have RS and RB. The average investor has partially invested in stock and bonds. So in terms of our proportions, if you have a shareholder, shareholders are 100% in equity. So their ratio would be 1 of equity to debt investment. But their ratio of beta to all assets would be 0. So these would be their ratios of investment. For bondholders, they're 100% invested in debt and nothing in equity. And the average investor is invested partially in debt in this ratio, which is positive, and partially in equity or in stock, which is also positive. I spend a lot of time on this notation because I'm going to use this extensively. So repeating what I said above, V is equity plus debt. An all equity firm only has shareholders, an all debt firm has bondholders, but a levered firm has average investors. All right. So we're going to speak about the average investor, and we're going to talk about, which again, you should have learned this in 3106. It's like a review, but these investors, the required rate of return is the return to the their weighted average cost of capital, WACC. So lots of things floating around here. We are going to calculate WACC as the better measure, as an improvement on the cost of equity when a firm has debt, right? So how is it going to work? It's going to be a weighted average. So the weighted average cost of capital is a weighted average of the cost of equity and the cost of debt. And everything looks fine, really, because this is my weight. This is like my XS, and this is like my XB, like my weights. But what's this all about? Can someone explain this to me, this term, 1 minus TC? This looks familiar. What is it all about? I mean, it's explained on the page, but if you can put it in your own words in the chat, that would be good. No idea. So the return to the average investor in the firm, this is what has to be paid out by, this is what's paid out by the firm to this theoretical average investor, right? So for every dollar invested by stockholders, they have to pay this required rate of return. And for every dollar invested of bondholders, they have to pay this required rate of return. But there's a twist here, because bond interest payments to bondholders, to creditors, are tax deductible. So this offsets the cost of paying bondholders. So this offsets it by, well, because it's tax deductible, they're left, they're going to get back TC of it, so 0.4, that's the tax rate, corporate tax rate of the company. They're going, so it lowers the cost by 1 minus TC. So this is known as the after-tax cost of debt. So because firms pay bondholders interest payments of RB for every dollar invested, however, the firm also incurs tax savings of TCRB that lowers the payout from the perspective of the firm. So I do this little calculation here to show you that this is paid, this is saved, so the net effect is this, and that's what you put here. Right. Thank you, Miss Al. All right, so that's where that comes from. So what we've talked about so far is the return, but the CAPM tells us, aha, but what about the risk, right? So this is the return measure, and what would be the risk? The risk is a weighted average, a weighted beta, and just like I talked about it when we began the class, you could find the beta of any portfolio as a weighted average of the betas of the components, with the weights being that proportional representation in the portfolio. So the beta of assets is just this weighted average. And I just make a point here, if you are to realize, the beta on debt is less and closer to the risk-free beta, which is 0, than to the to 1, which is the beta of the market portfolio. Okay, so debt is less risky because there's a guarantee and a threat against, there's an obligation of the firm to pay creditors. Okay, so it's like a threat against the firm. If they don't pay, they may be forced to pay, and even if it puts them into bankruptcy. So they can take, creditors can take the firm to court to get what's due to them. So that creates less risk for the bondholder. So if we assume that's close to 0, this whole term goes to 0, and you see that the beta of assets is just a fraction of the beta of equity. And so really, if you rearrange this, it's beta of equity must exceed the beta of assets. Okay, so it's more risky. The beta of assets, of equity is much greater than the beta of asset, or greater, let's say. All right, so let's return to the elements of the UR case, where now you are told, if you read the case part 2, you are told that actually the UR has debt, and the relative proportions of debt to equity are 0.47, you're given that number for debt, and 0.53 for equity. And then you're going to use this still for the return to equity, or cost of equity, and these are the values given to you in the case for the debt issue. So it's a 6.04% return to bondholders. And you have to make a careful calculation, put this all together, and look what happens. So when you introduce debt, it actually lowers the required rate of return, okay? Because debt is less risky and you're making a weighted average, so that weighs down required rate of return. So with leverage, the firm is going to be even more likely to pursue projects. Do you want to take a moment to make those calculations? Confirm what I have here. And evaluating the UAR project, the NPV will go up because now my CAPM went down. So this is the fourth calculation, not CAPM, sorry, my required rate of return went down. This is my fourth calculation of the cost of equity. In this case, I'm calling the cost of capital. So now WACC is known as the cost of capital, or average weighted cost of capital, because it has both debt and equity. Any questions so far? So this is the fourth recalculation. I've included debt now, and it weighs down the required rate of return and makes the project even more appealing. And the final thing we're going to do, unless you have any questions, is consider changing the beta of the Bahamas project, because it turns out that a little bit of investigation reveals that the Bahamas line might be more risky. And that's according to the industry beta. You know, some look at the industry beta, or maybe, you know, the beta for the industry of airlines in the Caribbean, and some other information that might be available. Now, in general, you might not have any information to start, right? To know, to use, or to come up with a required rate of return. You might not have any beta to look at. So you'd have to tread cautiously. You'd opt for a reasonable, you have to weigh, taking the risk versus, not, and not realizing a profit. It's going to be tough for startups to figure this out. Okay, so if your project's risk is different from anything out there, you're going to be challenged. But let's say we have reason to believe for the Bahamas line that the beta should be 5.5. Wow, that's much higher than 1.5, isn't it? So what's going to happen? Let's scroll back to what we did, recalculate the return to equity. So that is going to be 16.28. You can check all these calculations later. And then reweigh the 16.28 with the 6.04 return to debt. And now you're back to a required rate of return that's higher. It's now going to be 10.33. And so this is going to be the new required rate of return. The Bahamas project, remember, was only 10.26 in terms of the internal rate of return. So now we're saying don't invest. So this will be the fourth. Well, how many calculations? This will be the fifth calculation of the required rate of return. And you can see several assumptions that go into making these calculations. And one last thing that would affect your calculation, so this will be an additional consideration. What if you have other assets? What if you have something like the firm has preferred stock and it has that different asset class? So preferred stock holders get paid before common stockholders. So they have, so common stockholders are really the residual claimant after bondholders and preferred stockholders. So I actually give you an example to practice this, and what I'm going to do is let you go now because I fear we're going to lose connection again. And we can stop here and I can leave you guys to look at this for next week. All right, there's several problems to work on. As I said, this is really should be a review, but obviously I always go a little more deep into the topics than what you might have seen before. Okay, so you just had a basic, shallow introduction to these concepts, but now I want you to go through this exercise. This would be, I think it's the last one that I give you. Anyway, you have to work on all the problems. Don't just work on this. So next class, what we're going to do, let me see if I can pull it up. It's this one here. It's 18. So next class, we're not going to meet. I'm just going to send some videos, share some videos for you to review solving these problems. This next class is supposed to be a Monday or next Friday. And you guys can study on your own. Let me know if you have any questions. This is the last 518. One of, I don't know if it's the last because I know there's, let me see. What do I have left for you? Oh yeah, I go into 21, 19, 20, 21. So they're all review exercises. They're all preparing you for the test, the final test. So what I actually did was I put problems in Connect. So let's make a note here. I'm trusting you on this. I didn't know if this is, I'm trusting you that there's no class next week. Because Friday becomes a Monday. I'm just trusting you because I didn't look into it. I should probably look into it. Maybe I won't write this and I'll just email you guys about this after I verify. Not that I distrust you, but I should do my due diligence and verify. So I will send you a message about what's happening, but basically I put questions in Connect for you to practice. I have given you all these exercises with answers you can practice, and I will send some videos that you can practice so that the next time we meet, we're going to start the new material. Okay? So you have a lot of work to do before then. And there's a test, right? There should be a test. Let me verify. There's a test before the final. That's how I set it up. Oh, okay, so there's a test next week. All right, so this will work. This will work. So you guys have enough for the test next week. You actually do. So next weekend is the third test. So you will have from Saturday to, I can leave it till Monday night to send me your test. And then there should be a final exam which reviews everything. That will just be a Connect test. All right, so I will send you the resources that you will need. You have all these questions and answers, and they should prepare you adequately. Sorry for all the disruptions today, but you do have what you need to succeed on that test. Any questions for me before I go? We're good. Study, study, study. Keep in touch. Text me, email me any questions you have. Have a great week. Thanks for showing up. Have a good weekend. Bye.